According to the recent study, Americans are spending more and more time every day thinking about money.
And so this is a big deal, especially for our clients and how we're interacting with them. So my name's Alan Richard. I'm the managing broker here at Maximum One Realty and Realtor Partners.
My name's Ming Richardson, a compliance broker for Maximum One Realty and Realtor Partners.
And so the different generations spend different amounts of time really like focusing on finances and money, generally speaking. What's crazy is that for Gen Z, our youngest folks in the buying segment, they spend almost 5 hours.
4.82.
Yeah. Now millennials are really close at 4.7, right behind them.
While Gen X is only think about a 3.74.
And our boomers don't care nearly as much. They've made their money. They're in a good place, so they're only about 2.5 hours a day thinking about finances. So, like, for the folks who are thinking about financing and finances, the number one thing that most people tend to think about is
their bills.
Paying the bills.
Yeah. So followed by inflation, housing costs, and then debt management, and of course the administration with tariff and retirement saving.
Yeah, I mean, like that's always a big deal. About half the time, folks are thinking about, are they making more money this year than they did last year? And a lot of folks think that, gosh, like goodness, this is this a bit obsessive? Well, I guess it could be, but realistically, that's not necessarily a bad thing, because what really happens is when you start thinking about money,
it helps them think about their long-term goal.
Well, it motivates them, yes. Right? And so they tend to get really excited, energized, focused,
and goal-driven.
Yeah, and one of the biggest goals for a lot of Americans, buying a home, right? So home ownership is one of those goals that definitely falls into one of those places. Now, we are in a very unique place in real estate because on one hand, we don't we have a very symbiotic relationship with mortgages. On one hand, we aren't the people that originate loans. So we aren't, for most real estate agents, they are not a loan originator as well. Most of the time we partner with finance professionals. And so like we use Sharon, and we adore her, and she does a phenomenal job. The challenge, though, is that for the vast majority of consumers, guess who they go to for financial advice?
They're real estate agents.
Yeah,
they're realtors.
We are a very common question when it comes to things along the lines of financing a home, credit repair, all the way down to refinancing. So one thing we wanted to do today was we are going to talk a lot about financing and those kind of things, but we also want to be able to equip you to be able to answer questions with your clients, for your clients, and assist your clients. So one of the biggest things that questions that we get asked on there is how do I fix my credit? How do I build credit? What should I do? And so like right now, the median credit score in Atlanta is around
625.
Yeah, it's 625, which is not terrible.
It's fair.
Yeah. 620 is you can get decent rates at 620, that kind of stuff. However, Atlanta also has a huge number of renters, and see, a lot of those rental payments are not being recorded by the credit agencies. So we do have a new credit reporting agency or a new credit agency coming in, or where people are evaluating credit with different ways. They are starting to make up that, that help that segment to be able to qualify for more mortgages and raise their credit scores. But right now they're not a big player in the market. We see them moving into that position, but they aren't. So what do you do if you're a renter and your landlord isn't recording that? What about your, like I paid my rent every single month. I pay my utility bill every single month, or I got a car from a private seller, those kind of things. Well, there are some things that you can do as a consumer, right? So they can use things like Experian Boost or Boom Pay, Rental Karma, all these different services. We're not promoting any one of them. What we're saying is that if, when our clients say, hey, what can I do to raise my credit score? Well, are you using one of these rent and utility reporting services, because they will report that to the credit agencies.
It does cost you, in the average, the cheapest around is about $10 a month to do that.
So between $8 and $10 kind of thing in there. So some are really, really expensive, up like the $50, that kind of stuff. But we see that if you can just get those things added to the credit, it can really, really assist your
credit
borrowers.
scoring. And also, Linda does require 2 credit trade lines. So if you don't have any credit trade line, you might have a very difficult time obtaining a loan.
So right now there is a lot of talk about mortgages because we see so much movement all of a sudden, and we're very, very pleased to see that. Now let's talk about what's the really good news happening in the mortgage world right now, is that as it pertains to real estate, right? So for a home buyer that has around a $3,000 budget, they just increased their purchasing power by, drumroll please,
22,000.
Yes.
And you're wondering, where's that number coming from?
Well, we're seeing interest rates that have been softening up, and so we're really glad to see that. Matter of fact, we have the deepest rate cuts in over a year. So right now, mortgage rates are at its lowest point in well over a year. So right now, we're coming in the
low sixes.
Yeah, low sixes is kind of where we're at, and we're seeing that's overall, but like we're seeing where the government loans, like the FHAs, are coming in even at under 6 on there, and that's partly why we're seeing so many people leaning towards FHAs right now. So we are seeing where interest rates really have been softening up, and those have been a really good thing. Now, even this week coming up, the Fed is going to be meeting on Wednesday of this week. And, everyone has pretty much expected that there's going to be a cut. There's going to be a cut. Not only that, the market right now is really expecting 3 more rate cuts this year. And so we feel like that's a really good place to be. We're glad to see softening on interest rates, those kind of things. The other thing that like one of the things that really affects mortgage rates is the 10-year Treasury. So anytime the 10-year Treasury moves, then we see interest rate moves. And so we are really glad to see that the 10-year Treasury has been softening. But the other thing that's kind of happened is we also have this spread, and it's this little margin between where the 10-year Treasury is and where the 30-year mortgage rates are. And historically, that has been closer to like 1.7, 2%, that kind of stuff. It had been running over 3, like a 3%.
Which is huge.
Yeah. And so now it's down to 2.25. And so it's getting much, like that spread's getting smaller. And so when you have the 10-year Treasury softening, you have the spread tightening up a little bit. All these are really good factors for moving forward in the real estate market, right? So we are looking at interest rates. We're not looking at interest rates dropping back to the 3s and the 4s. Like understand that was a time in our history that
was a unicorn.
Yeah, it really was. Like those were not normal times. We were coming at it, or we were in COVID at the time. The federal funds rate was at 0%, and on top of it, the Fed Reserve was actually buying mortgage-backed securities. So they were buying huge bundles of these mortgages on top of them. That was all done in reaction to what was happening with
to the market
COVID
and
that
COVID,
kind of stuff.
and they were trying to promote and stimulate the economy as well. And so that was a artificial stimulation, which I don't foresee federal fund ever will go down to 0.
Not for a long time.
I could be surprised. So.
Well, inflation still isn't where we want it to be. It has moved. It is better than it has been, kind of thing. But there's still a lot of talk about tariffs and how those impact the market. So we do see mortgage rates softening. We see mortgage rates continuing to soften. What we don't expect is to have, like we've had some pretty drastic moves of late, and we think that there's going to be a real flattening out of that, and then a continued kind of softening as we move into this year and into next year, kind of thing. Now, as those rates soften, that's a really good sign overall for real estate because it improves affordability.
And just a little study here, in first quarter of 2025, only about 41% of the homeowner that was surveyed say that they would accept a mortgage rate up to 6%. So now in the third quarter, the percentage has gone from 41 to 52% that they will accept a mortgage rate up to 6%.
See, our homeowners are coming to terms with the fact that you know what, their mortgage rate is not going to be 3%. Their mortgage rate is not going to be 4%. That's not realistic. And historically, like Ming said, it was a unicorn right there. And so those same percentages carry forward. Whether you're talking about more people are expecting higher rates than what they were expecting before. If you like the number of people that would accept a 7% rate is higher than the number of people before. So like people are coming to terms with this is the market realities. This is really how it is. If you didn't buy during those times, then you're not going to get those kind of crazy rates. But we are seeing nice movement back into the low sixes. We see where our builders and we see where our FHAs and those kind of things are even under 6 right now. All that, however, has kind of like spun up. Yeah,
spiked some of the mortgage activity. So we're probably the highest in the last 3 years because the interest rate. And apparently there's about 12% that have started refining. So that's huge.
Well, I mean, refi is up 35% from where it was last year. Overall, mortgage purchase applications, which is the one that really affects us the most, those rose by over 7% last week, and they're almost 25% up where they were last year. So to be kind of going into what's normally like a tapering off time,
I think we're going to have a really good fall season.
Yeah, we're seeing a lot more activity on, and see, this is one of those numbers that like doesn't really equate until they actually buy. But when you say, look, mortgage purchase applications are up 25%, well, in the next month to 2 months, those purchase applications are going to turn into purchase and sale agreements, right? Because that means these people are going to start shopping much more intently right now. And so that's a really, really good sign. Because, see, every time that these mortgage rates drop, that really does impact the affordability for our buyer. So you got and being able to articulate that, understand what a big impact that really makes. So if you have someone looking for let's say $400,000 home
at 7% interest, their monthly just the principal interest, accounting, taxes, all the home warranty, hazardous insurance, their monthly mortgage is around $2,661.21.
Yep.
So if we drop to current rate, which is around 6.29, their monthly mortgage is $2,473.28. That is almost a $200 saving.
$200 a month. $200 a month is a big deal.
Huge. Yeah.
Yeah, I mean, $200 a month is a big impact for most families, right? That changes whether you decide to buy this house or this house over here, because it's improving the affordability for our buyers. So being able to understand that as a real estate professional and to be able to articulate that to your clients, super important. Now, what does that do overall to the market? Because we've had rising inventory, and right now new listings coming on the market are under where they were last year because the market's kind of like there's been a real flattening of prices, those kind of things.
Leveling off.
But you got to understand that when mortgage rates drop from 7% to 6%, that means that there's going to be almost 550,000 more people applying for mortgages, right?
They're eligible to buy, meaning that they're now able to afford a home.
Yeah.
And that 5.5 million includes 1.6 million current renters.
Right.
And that is currently eligible for.
So I mean, if they drop, we're talking about 5.5 million additional households ready to buy, and 1.5 million roughly renters ready to buy. Like, the whole real estate paradigm kind of shifts a little bit here, and we're kind of in this right now. What we want you to understand is don't be sitting on the sidelines. A lot of times we see our business overall as an industry, and especially here in Georgia, like we start coming out of summer, we're moving into the fall season, things start slowing down for a lot of people, and a lot of real estate professionals just kind of figure out, well, it's time to cruise a little bit. It is not time to cruise right now. Right now is the time to actually be doubling down on engaging with your clients, educating them about what's really going on, helping them to get ready, because you may be busier in October than you've been in
the summer,
in
July,
right.
and June.
Now, we do want to touch really quickly on refinance, because any time that we see mortgage rates start moving in a direction, then a lot of our clients start asking us, hey, should I refinance? What do I need to do to refinance? Those kind of things. So just a couple of rules of thumb that we want to throw at you, just so that you can offer sound advice. So they won't be able to refinance for at least 6 months.
Correct.
So they have to have their mortgage for 6 months. But then at what rate does it really kind of make sense? Like what we see is that, well, let me start and say, when someone does refi, please don't think that the mortgage companies are like, just come, there's no fees involved.
There are fees involved.
There absolutely are fees involved, right? And so anytime that you refinance, there has to be enough of a drop to where it actually does kind of make sense, and to where that they can recoup that investment. And then also, are you ready to add more time on? Because let's say that you've been paying for a year and a half on your mortgage, and now you want to refinance. You're starting back off at 30 years again. Or maybe you can get a 25 or those kind of things. But generally speaking, for most borrowers, they start back at 30 years again. So now it's kind of like you just set the clock back. Is that a right thing to do for them? And then, how much of a drop do you really, really need? Like here in Georgia, the average refinance, you need to be planning that you need to hold that home for 3 years, just to where that refi is break even here in Georgia.
Yes.
And so what that rate really does mean, though, is that if you want to see refinance savings, you really need to get at least 3/4 of a point drop from where you are. So if you're currently at 8 and you wanted to go today at 6.2, well, that's a 1.8% drop.
Mm-hmm.
That one is for sure kind of a gimme. If you were even at 7% and now you can get it at 6, that's a 1% drop. That is still probably a smart move for you to do if that's right for your family and those kind of things. But if you were at 6.5 and you want to go to 6.2, for most time that's not a smart.
Make sense.
It's going to take too long. You're adding the cost of the refinance in, those kind of things. So just remember, like 0.75, 3/4 of a point is really what you kind of need to be able to jump into.
So if you were the buyer that at one point when the interest rate was 7.75 or 8, right now would be a great time for you to
smart,
refi.
yeah. But again, I know that we aren't. We fully understand that we are not out here promoting refinances, but because we are a trusted guide, friend, advisor, like this is also a very good role for us to be. It doesn't affect me if friends of mine go and get a refinance, but if it can make their life better because it saves them some money and they have some questions, look, these are the kind of things where we are the subject matter expert. And I know that we aren't truly the subject matter expert. They need to talk to a mortgage professional.
But we're a good source for that to get the expert opinion.
And chances are they're coming to us anyway. So go out, engage with your clients, really like talk about what's happening in the market, be engaging, build relationships. Right now is a great time to be a realtor.
Well, thank you so much for watching us, and we look forward to seeing you next week.
Have a great week.
Thank you.
Bye.